Hi, everybody. I'm Pam Kruger, the founder of Wealthramp.com, and I'm also the co-host of Friends Talk Money, the podcast that's on PBS Next Avenue. For anybody who doesn't know, Wealthramp is the place where you come when you're looking for the right financial advisor. These are advisors who work only and directly for you, not as sales reps at brokerage firms or for insurance companies. So when you do want an advisor, and you want to know that that advisor is legally bound 100% of the time to look out for your best interests as a fiduciary, you come to wealthramp.com as you go to. Well, welcome to our Wealth Builders series. You asked if you could hear from our advisors every now and again. So once a month, I take one hot topic and I go into a deeper dive and hear from one of our experts, which also allows you a chance to get to know that expert. Today's interview is kind of called, I titled it, Ready, Set, Retire. Really? Because what I want to focus on today, especially in this environment, is the feeling of retirement security, financial security. So we're going to talk a little bit, just for a quick second, about what you probably have been reading about with this Secure Act 2.0 legislation. And we're going to just talk about the major things that might impact your 401k or your individual retirement account that should help us all save a little bit more. And we're going to look at some of the most popular strategies and considerations around IRAs and 401k accounts and around retirement savings, and also touch upon how these strategies might be changing and adjusting in an era of rising inflation, obviously with inflation over 8% at its tipping point here, and interest rates that are on the rise. So I want to introduce to you our featured guest today. Eric Olson is a certified financial planner and a retirement strategist. And Eric's going to walk us through these topics that we're going to touch on. He's with Arete Wealth Management, which is located in Chicago. Let me tell you, because I've known Eric for quite a while, when I say that he has an extensive research background and he's analytical, I'm not kidding. So he helps his clients grow and protect their money in challenging market environments, especially when they're changing. And he's just one of 240 advisors in the Wealthramp network, and he is accessible to you. Welcome, Eric, and thanks a lot for taking the time today.
Yeah, Pam, thanks so much for having me. You highlighted the analytical part. I did, just to let you know and our listeners know, I did take the plastic pocket protector off. I did take the tape off the glasses, and I'm not wearing the calculator on the belt today. So I just wanted to be just much more accessible to your listeners.
I just really like you the way you are. Don't go changing. Don't go changing for us. But Eric, let's just set the stage a little bit, because so many people have been reading about this secure legislation, this 2.0, and I don't want to get into the weeds and talk about, well, what if? But I do kind of want to focus on the things that could change, because the House passed Secure 2.0. It heads to the Senate now. And it is a follow-on to that secure bill that was passed back in 2019 that had a lot of bipartisan support. What do you think are the things that this legislation, but people need to know, can help them the most out of this?
I guess I put it this way: the things to look forward to would, and just in sort of quick succession here, would be number one, a much bigger opportunity to have contributions, particularly catch-up contributions, as well as matching contributions from your employer, be directed into the tax-free part of your plan, as opposed to every dollar going into the pre-tax part. That's potentially huge. Another is that if they push the age at which you're required to take minimum distributions from the IRA from 72 to 73, 74, all the way out to 75 over the course of a decade, that'll also have really big planning implications. For some people, that'll be a big advantage. For some, actually, that will be a harm. If you want to talk about that in another episode in the future, we can talk about the pros and cons of that. But I think those are two of the biggest changes. The third, maybe for those that are really big charitable givers, there's also going to be there's relaxed constraints on some big giving from your IRAs and 401ks.
No, that's excellent. So when we talk about pushing it over to tax-free, what we're talking about is that the catch-up provisions can be directed into a Roth
The Roth
way of
component of your
saving.
plan.
The
Yeah.
Roth component, which we love.
Mhm.
Okay, so at the same time, I want to kind of have you walk us through. I think you have about 6 considerations that
Mhm.
you think that people need to be looking at in succession right now. Again, we're focused on retirement security and
Mhm.
feeling more secure in throughout your retirement. So I'll just let you go ahead and delineate the 6 considerations.
Sure. These tie in with this broad question of how do I feel? How does a client that, let's say that client's got a 500,000, a million, or what have you, and their primary question is am I going to be okay? Many planners and much self-planning, I would say, is focused on merely one question within this, and that is, is there enough? It's a sufficiency directed analysis, and that's fine, and everyone needs that. I'm not disparaging that at all. What I would say is that it needs to go beyond that, because if you can move from a mere sufficiency analysis to then augment that with an efficiency analysis, you can usually find resources in tax avoidance, not tax evasion, but tax avoidance over the full arc of your retirement, that can mean the sufficiency question is answered differently and more favorably for you.
Okay, so if I translate that,
Mhm.
what I'm hearing you say is that tax focused planning in retirement is critical
Mhm.
because we're all worried about having enough. What you're saying is that's fine, but have your eye on the ball for tax efficiencies and strategies that can be deployed that can really help you keep your more of your nest egg from going to taxes, of course, legally. Every
Mhm.
strategy is legal.
Mhm.
Okay, so what's number 2?
Well, so that's the framework. So the first, but
Okay.
within that framework, and people who are saying, okay, well, what is, okay, Eric, you're saying we should be looking at efficiency, not just sufficiency. How do we go about that? So I would say the step number 1, and I'll just list these off, and if you want to explore them further, but just to give you an big overview, step number 1 is do some sort of life expectancy analysis. I will say 5, 10, 15 years from now, they'll have blood tests that will get us a lot closer on this. But for now, even, there's some
Yeah.
instruments that have been validated over large population samples that can get you closer than just looking at the broad life expectancy tables population wide. The
Am I
second
am I
thing,
am I
sure.
am I going to take that to mean that I'm going to find out the date of my death ahead of time? Ah,
Well, you'll find a range, and if that range gets you closer, especially if you're, let's say, doing planning as a couple, and now there are 2 life expectancies that are at issue here. Let's use my
right.
wife and me as an example. What if she winds up living to 100? I'll wind up living to 80. The outcomes of the financial plan that uses those as the life expectancy assumptions is almost certainly going to be very different than the plan that uses a life expectancy assumption that's reversed and or that's in the
Sure.
middle. So we want to, what I advocate for our clients is that we look at that planning process using a variety of life expectancy, short, long, and in between for both of them, so that we can see whether or not there are any sort of vulnerabilities in there. That's a very different set of outcomes sometimes than just saying, oh, well, I'll hedge against the possibility of long life and I'll use 95 or 100 for everyone. So life expectancy assessment, I think, is a starting point. Second is nailing it on the guaranteed income, including Social Security, and having the optimal Social Security claiming strategy. For some people, that optimal strategy will be waiting and each of them until they're 70, but oftentimes it's not. And so without getting into the weeds on that, getting that right is important too.
I think
Third,
that I read
yeah,
where
go
there's
ahead.
something like I think I read where there's something like 8,500 permutations of
Yeah.
claiming strategies. And so obviously that is a world unto itself, but I
Mhm.
appreciate you pointing that out because, obviously your social security strategy and your timing on it and interplays with your health, interplays with your financial plan and your investment strategy. Okay, so that's very important and
Mhm.
needs to be very considered very carefully. So number 3,
And incidentally, just that is life expectancy dependent as well. So that's why
right,
you want
right,
to have those 2 working together. The third and the fourth, though,
right.
start to really get into the topic that you had sort of started out with. Hey, we've got this exciting world of tax deferred, tax free, taxable accounts that we're using to store away, stash away funds for the future. And then how do we avail or access those in the wisest way to have the most that we're able to spend and the least unnecessarily handed off to the IRS? Well, I would say 3 and 4 in this series of 6 things go hand in hand, but they're conceptually separate. So let me just treat them separately. First is, should I do Roth conversions? What do I mean by a Roth conversion? That means in a year, taking X number of dollars out of my IRA and placing it directly into my Roth IRA, paying taxes on it in the year in which I make that conversion. Oftentimes, we can identify instances in our lives where we can foresee years where we'll have very little competing income, and hence we'll be in a relatively lower tax bracket than we will be in other years. Wonderful opportunity, all else being equal. That's an important caveat. All else being equal, that's a wonderful time to look at possible Roth conversions. The fourth thing, though, which goes right along with that, is what's the best way to pull money from my various accounts? Should I, for example, if I have half my money in 401ks and IRAs, a third of it in taxable accounts, and a sixth of it in Roth IRAs, or whatever the balance is, and it's going to vary from every single person, should I drain one, then go to the next, drain it, then go to the third? Should I do a mix and match? Should I do a mix and match and then go to a draining strategy? Start with a draining strategy and then go mix and match? What should I do?
Eric, let me just ask you one quick question here with regard to Roth IRA conversions,
Mhm.
because a lot of people who are too wealthy, or they make too much money, I should say, their income is too high to contribute to a Roth IRA. There's such a thing as a backdoor Roth that wealthier Americans can use. And the reason it's called backdoor is it's kind of a workaround where a person can actually fund a traditional IRA or non-deductible IRA, I should say, and then immediately convert that to a Roth IRA, which means they will not have to pay taxes down the road. So for a minute there, it looked like that was possibly going to go on the chopping block, but it appears that the backdoor Roth IRA is still a viable strategy right now for wealthy people.
Yes. So let's put this in context. So by far the most powerful way to move assets from a pre-tax 401k or a pre-tax IRA into a Roth is through the conversion process. That's available to both those with the highest to the lowest income and the highest to the lowest assets. But if we do want to talk about, is there another way on top of a conversion that you can use to get money into that tax-free category? Yes. For those that have been disqualified by virtue of their income from making contributions to an IRA, Roth IRA, I meant to say, they can contribute on an after-tax basis to the pre-tax traditional IRA, and then transfer that over to the Roth. And since they contributed over they contributed originally to the pre-tax IRA on an after-tax basis, then moving that portion over to the Roth, they don't have to pay taxes on that. The problem is with that is that those conversions are done on a pro rata basis. And so if you said, I've already got $1 million in my IRA, I put in 5,000 or 6,000 this year, and then I want to do a conversion of, let's say, that same $5,000 or $6,000, only a tiny fraction of that, because it's done on a proportionate basis, would then be done on an after-tax basis. So the mega backdoor Roth is the thing that people are talking about even more than that. And that is where you have the contribution to not only the after-tax contribution to the profit sharing part by the employer on your behalf, or you can make that contribution on an after-tax basis. That part can be selectively moved over to the Roth side without having to do it on that pro rata basis. So that's a powerful approach.
So this reminds me of the story that we've all heard. For all you billionaires out there who don't already know this or have an advisor advising you, this is where the PayPal founder, what the spotlight went on Peter Thiel, because I think he had something like $5 billion at one point in time from his company, for his Roth IRA, which would have been ostensibly not going to have to pay taxes. So the mega RIA is for the billionaires. the backdoor Roth IRA and the regular IRA is for the people who are mostly your clients. I mean, your clients are mainly people who are saving and investing anywhere from, $500,000 to 10 million, 20 million. But you'd certainly work with a fair number of people who I would say are probably 500,000 to 1 million and 1.5 million to 2 million in total savings.
Right. And I would say sit down with your advisor or your tax advisor, one or the other, and figure out how to go about it. I do think the backdoor Roth IRA, we use that a lot, and we use the mega backdoor Roth IRA on occasion. But I would say it's overwhelming the conversion process we use. There are ways to make this happen, and get good counsel, and you can make it happen in a way that you'll be really glad about, I think, down the road.
It's still alive. It's still viable.
Still alive.
Okay, Eric, what's number 4?
Number 4 is then as I was saying, to optimize where you pull the money from. And you cannot answer that question. Should I pull it again from the IRA, the Roth IRA, the taxable account? Or should I do some of each? What should I do? That's a really individualized analysis, and it depends on a lot of factors, but it goes hand in hand with the question of Roth conversions. If you have zero money in tax-free accounts, then your answers to that optimal withdrawal strategy will differ than if you do Roth conversions, and whether you should do Roth conversions will also differ, or should do Roth conversions will also differ on the composition and your answers to the optimal withdrawal strategy. So they're inseparable, but it's a powerful technique used in conjunction with one another to make more of your wealth spendable by you and less of it owed to the IRS.
Right. Okay. So
Mm-hmm.
yeah, I was just going to say these 4 so far, everything is, makes sense because it's all in conjunction with
Mm-hmm.
decisions that you have to be making. And I love the fact that you're calling these considerations,
Mm-hmm.
because if anyone's taking notes, I mean, in other words, these are the things to be mindful of, to be
Mm-hmm.
aware of. Okay. Sorry. So number 5.
No, sorry, this is fine. This is great. So number 5 is the question of everyone's familiar, I think, with the concept of asset allocation. In other words, let's say I'm a moderate investor, hence I should have X amount in stocks of various kinds and X amount over here in bonds of various kinds and what have you. Everyone's familiar with that sort of pie chart analysis of how to sort of diversify your portfolio. But a second consideration is what I'll call not asset allocation, but asset location. In this question, what you're asking is, okay, let's say I have more than one kind of wealth, meaning more than, from a tax standpoint, more than just an IRA. I also have possibly some taxable assets, or I also have, because I did some conversions, I have some Roth assets. If I've got more than one type of asset, now the question is should I build my so-called, in this example, moderate portfolio identically in each of those 3 tax categories, or should I have that portion of my portfolio that's in my tax deferred IRAs look different than the amount or the framework that I use for my taxable accounts, and hence also for the Roth? Now, so and most people say, never really thought about that. And you'd be surprised. A lot of advisors have never even thought about that, which always puzzles me. So if I were to ask you, Pam, if you could pick one of those 3 buckets, tax deferred, tax-free, or taxable, that you would want to see grow the most over your lifetime, which would that be?
Well, the inclination is to say the tax-free, anything
You're
that would
right.
be in my Roth, that would be what I would presume.
All else being equal, I think most people would agree with that. So then why would you build, if you're a moderate investor, why would you put any of your slow growing stuff over in your Roth? Instead, you'd probably, all else being equal, say, I'm going to put more of the high growth, tax inefficient things in my Roth, the slower growing, tax inefficient things in my IRA, and the remaining tax efficient things in my taxable account.
Absolutely. Yeah, that makes perfect sense. And then a lot of people have real estate as well.
Mm-hmm.
And they have cash flows, from real estate. But these days with, people have rental properties and other assets as well. Okay, so that's asset location, not only asset allocation, but asset location.
Mhm.
Okay, so that was number 5. So
Mhm.
number 6,
So
consideration.
all of the first 5 have been very, I would say, objective questions that are objectively answered. This last one is more subjectively answered, and this is really understanding your personality, but about spending and about change. But it does have an impact on how we answer many of the other questions. And the question is this: if, of course, none of us knows what the next 30 or 40, 50 years of what life is going to, what hand life will deal us, and none of us know particularly what hand the overall economy and markets will deal us. We don't know if we're going to have disproportionately many years of high inflation or low, or in between, disproportionately many years of
Yeah, we
high
can't
returns or
control. We
low.
can't predict and we can't
Right.
control. Right.
So if we run into the buzzsaw of numerous, too many years of high inflation and low returns, of course, that's going to mean that whatever sufficiency questions that we might have answered in general are probably going to be overestimating what we'll have. But the opposite also could be true. So some people, though, say, I want to guard against the worst case. That's fine. I'm not in any way suggesting you shouldn't. But there are other people that would say, you know what, I don't necessarily want to pre-assume that we're going to run into, over the balance of my lifetime, that worst case environment. I would rather wait until let kind of time play out and unfold and show us what kind of hand we've been dealt. And then if it turns out that we're getting more than our fair share of poor returns, high inflation,
Yeah.
then I'll make adjustments.
Right. But Eric, it's like, I know that some people are very, very good at using their own spreadsheets, if you will. I mean, my brother was like that. And he was really good at it, and he was an engineer. And I think that most people, who are coming to me, coming to us, coming to Wealthramp, watched my show on PBS, they're really saying, this is complicated. There's a lot of moving pieces and parts. And what I'm hearing from you out of all 6 considerations is, whether you're doing it on your own or whether you do hit the call for help button, it's really important that you have a sense that financial planning is not rearview mirror. Financial planning is dynamic. It's not static. It's not right now in the present only. The only way I can think the way you just described in number 6, and knowing myself, and I was thinking about myself when you said that, is to plan it out a little bit ahead so I can stress test. I'm a big believer in stress testing different scenarios. And so right now we've got some headwinds. We've got inflation. We've got rising interest rates. We know that there's pressure on anybody who has bond portfolio that has a typical bond that might be 10 years out. You're going to see the prices and the value of those already, I think, going down right now. Of course, we're going to see interest rates continue to rise because the Fed has not made a secret, whereas they used to be very secretive about these things. And now they're just wide open saying, they're coming, we're going to raise rates even more. So in terms of looking at where most of our 401k, most of our IRA money is invested, in the stock market, in a broad portfolio like an index fund, ETFs that represent the whole market. I'm not just betting on one horse. I'm betting on the whole horse race by owning the entire market. Talk to me a little bit about how you see using all of the 6 considerations looking forward, with inflation and the possibility of maybe some headwinds on certain companies whose profits might impact the overall performance of the overall stock market in a negative way going forward, if interest rates are rising. I mean, how do you plan for that right now?
Great. So there's 2 ways that we approach that and those challenges with our clients. One is on the planning side, and it includes those 6 things that we just talked about. But it is, as you said, stress testing the portfolio. What happens if, fill in the blank, this stressor is introduced, whether that's market drops or higher than normal inflation or any number of other possible stresses. So
could be your health. It could be that your partner's, your spouse's health. Yeah.
Absolutely. Okay. The second response, though, is to talk about the composition of the portfolio and whether or not on some sort of tactical level, it makes sense to make tilts in the composition of the portfolio that respond to the unfolding circumstance in front of us. So for example, on the bond side, you've already pointed out, because interest rates, the Federal Reserve has announced we're going to be raising these rates. There's no secret about that. And what you're seeing is that the bond market is responding as you would expect it would, with declining prices for bonds. Listeners understand, I think, that interest rates and prices of bonds are inverse. So if you raise interest rates, you're essentially going to be, the response will be a decline in the pricing of those bonds.
Otherwise known as, you will see the value of your bonds go down, just like a stock goes down in price, and that will not feel good. Yes, obviously.
Mm-hmm. So holding things to maturity, if you own the bonds outright, you'll still get the outcome that you banked on. If barring any sort of credit default, you'll still get the outcome that you thought. But if you're investing in a bond fund or bond ETF or something of this kind, you should expect that the price response will be, in the face of that, a decline, and that's what we've been seeing. Similarly, on the stock side, if you see interest rates rising, then anything that is predicated, the value of anything that is predicated on future cash flows, those increased interest rates then necessarily imply that you should use a different discounting factor for future cash flows.
And so in other words, it gets priced in. It gets priced into the price of the stock today. Yeah.
In a zero inflation, zero interest rate environment, $1 10 years from now is worth $1 today. But if you say it's an environment of 8% inflation or 3% interest rates, that dollar 10 years from now isn't worth $1 today. And so the more those interest rates rise, or that inflation factors in, the less we value that dollar 10 years from now. Hence, stocks, namely in the growth category, that are predicated largely on their future cash flows, not their present ones, have been suffering in this environment, just as we would expect. So on the investment side, we're talking with clients about the role that value-based investing as opposed to growth investing can play in their portfolios, despite the dominance of growth over the last decade. We're talking with them about the role of potentially commodities, or at least commodity-based businesses. We're talking with them about a variety of approaches on the bond side that are alternatives to bonds. There's many things. And of course, I don't want to make any sort of single one-size-fits-all prescription for listeners, but I do want to say that it's useful to think about how to tactically introduce tilts into the portfolio in response to some of these unfolding considerations.
Right. What you're describing are tweaks and adjustments. And we're talking to people who may never have had an advisor like you, I mean, who really gets into this and really gets into the details at a granular level. And for people who are, that $500,000 nest egg, or that $1 million nest egg, really concerned that they don't outlive their savings. I think to really summarize everything you're saying is the 6 considerations that you laid out, in combination with understanding that everything we're saying sounds so darn complicated. But when you really put it into buckets, and you look at these 6 considerations, you kind of tick them off as, they're very practical. And if you've already been doing a lot of rebalancing and you're already doing this yourself and doing it well, then maybe it is just tilting, and maybe it is just tweaking, or doing that tilting and tweaking with your advisor. But also understanding that if you are doing it yourself and you haven't been doing any of this, I think that the thing that I would be thinking about, maybe you agree, is this is a really good time, because you may have money that's in bond funds that you might not be happy with in another 6 months to a year. Like if you're not happy today, you might be even less happy as interest rates increase if you're hanging on to those. And it is a good time to, just review all of these tax-focused strategies in combination with your investments and your plans on withdrawing money out when you retire. And of course, the biggest question, Eric, is, and this is the biggest question in my mind, is people who were thinking that they are going to retire, say that they're 67 and they've put in a number of years at the office, and they're like, I can't wait to step away. This is a good moment to stop and reassess all of it, because kind of plucking out what you said, in these considerations that stays with me is all these other things that have to do with the economy and things we can't control to do with inflation and interest rates and other geopolitical tensions. It might be longevity that becomes the biggest threat to our retirement. We might just find ourselves living into our 90s and maybe beyond that. I see it more and more with my friends, with their parents, and they're living these long lives, hopefully healthy. But that is just a huge consideration to think about when you're going to retire.
Pam, you're talking about longevity, and I think it's important for our listeners to just understand. In a baby born in 1900 had a life expectancy of birth, that is to say in the United States, a baby born in the United States in 1900 had a life expectancy at birth of 47. That a baby born 100 years later in year 2000 had a life expectancy at birth of 77. 30-year expansion. You think about all of human history, and in that 100-year period of time, you had an elongation of the life expectancy at birth of 30 years. Now, that's different than life expectancy at 65, but that process hasn't stopped. There are ongoing breakthroughs being made in genetic and biotech and so forth. I fully expect that within, hard to put a number on it, but I'll say babies born within 20 years, many of them will have life expectancy stretching well into their hundreds. And so with that sort of changing landscape, all of us have to do some thinking about,
how am I going to take care of my older self? I don't want to be in my 90s and run out of money. So my point is, all joking aside, it is just a huge piece of the question, because we can't stop ourselves from thinking, 65, we're going to retire. And then, you're talking another 30, maybe 35 years that you're going to coast off of your savings. So I think, the timing of bringing in that question right now, given, changes in the economy and considerations we have to have about, what's it really going to take to be able to, stretch that money out for the rest of our lives. It's huge.
You're so right, Pam. I think in the final analysis, the way I would just characterize this is the single biggest financial liability that people will have to fund in their entire lifetimes. It's not their home, it's the how many ever years they spend beyond earning a paycheck. It's so much rests on there's so much, I would say, import to getting these decisions right. So I would just strongly encourage listeners, if you're not working with an advisor, to talk to a number of advisors. Don't just say, hey, the first one we met was nice, let's work with that advisor. Instead, talk to a few advisors and find out how their brain works, what their process is, and exactly what sorts of things they'll examine. You deserve to have these things examined for you. And I really would say no one should be without this.
And taking, when it comes to, calling for help, I always try to counsel people, stop, take your time. This decision has to be so thoughtful, because there are so many, everything's at stake now. Your whole life savings at stake. This decision has consequences. Who I'm going to rely on to guide me into retirement is everything. So that's why I feel so strongly, obviously, about fiduciary and about fee only and full transparency and having the competency in the background, the qualifications. And Eric, I'm going to wrap on that, because you bring that. And I'm not just saying that because you're here. I have talked to you so many times, and I've gotten to know you, and I know the clients, who have already gotten to know you. And I'm very fortunate that you're part of our network, and I appreciate you. And we'll have you back again to talk about, another topic. But you've given us a lot to think about with the 6 considerations, and then also the focus on longevity, because that's a big deal. So I just want to say thank you so much. This is Wealthramp Wealth Builders. We do this every month, and I promise you, I'm going to email you ahead of time for next month's video, so you can know that if you wanted to, you can join us live if you want to, and you can ask questions directly of the expert that we're interviewing. Or if you're shy, you can just email your questions into us ahead of time and request a topic, and we'll talk about that. And you can reach Eric because he's one of our 240 advisors in our Wealthramp network that I've hand selected. But you can ask all these questions at Ask Pam at wealthramp.com, and you'll find Eric at Arete in Chicago, Wealth Management, Arete Wealth Management in Chicago. Thank you so much, Eric.
Oh, my pleasure. Thank you, Pam. It's wonderful to hang out with you.